I hope I am audible enough to everyone. Regarding your assessments, we have taken some decisions to reduce the number of quizzes that we originally planned to have because of the mode of lecturing and the constraints that you all face. As a result, we'll reduce maybe 6 or 7, out of which we'll take something. We'll let you know how lectures would progress, but at least there will be minimum 6 quizzes. Your second quiz will be uploaded to the system LMS within this week. If you have any concerns arising from previous lectures or any matters pertaining to the course, now you can ask before starting today's session. Right. Am I audible enough to everyone? Okay. Okay, thank you. Yeah, there are comments like, yes, we also understand your desires and the need of having lectures. When I too really bored of lecturing online. To be honest, this is not online lecturing. This is, of course, technically it's right, but when it comes to online learning, it should be a different way of teaching, because the environment should be totally different. You need to have such equipments, interaction should be there, so it cannot be done by like our individual efforts. It should be a separate dedicated room. Here also now some rooms are there, but as of now, according to my assessment, we are not in a really position to have effective online teaching or learning. So this is something that we happen to do since we do not have any other alternatives of facing this crisis. Sometimes it looks like decisions go beyond the information or logical reasoning. So that is a decision to reopen the university. It depends on desires and commitment of authorities. Also how important the university education is. As of now, it seems like those who take decisions and those who have influential power have regarded something like university education is not that important. It is something like just to confer you degrees. It's not a learning place. So that could be the reasons why authorities have simply disregarded this thing. Do not know, we need to check whether it is learning place or not. But the real meaning of a university is something like just you must come here. Actually, you don't get any exposure from the university if you can't visit like be with others, interactions, and lots of things are there. So that is part and parcel of the life. So I agree with what you commented here. Will, if it's my decision, I will just take measures to immediately open, because only thing we need to make sure about the health measures, that is not a big problem. Anyhow, as of now, so there is a great possibility that universities will be open soon, maybe early December, or I'm not sure whether it would be within this semester, but discussions are going on that way, and some arrangements from the university end have been already made. We'll see, we'll wait, because we are connected to UGC and other top decisions as well. We hope for the best. Hope that we would see you soon, and you would be able to have physical university life. Lecture recordings will be also uploaded soon, because again we face some difficulties now. We can't directly upload this to LMS. We have to upload that to YouTube and give the link. Again, it takes time and constraints are there. And immediately after today's lecture, I'll upload my previous one, and I will ask Dayanand sir also to upload his one. That. Okay. Right. Again, as I told you in my very first lecture, the learning happens if you talk, discuss, and not only listening to me. The last week you learned about intangibles, how intangibles are important to an entity. As the word intangible implies, intangibles do not have any physical substance. Then you may raise a question, if there is no physical substance, so what's the use of, like, when we talk about entities deal like with physical things. So how and why something which do not have physical existence are considered in preparing financial information or preparing financial statements, which contains financial information. So last week you must have learned how important they are, especially when we live in a technology-driven world. To great extent, there are some other reasons as well, the market reasons, patent rights, and lots of things, assets appear in the form of intangibility, right? Some rights, mainly some good image, abilities, ways of organizing things, lots of intangibles play a significant role in the balance sheet in entities. So that is why and how intangibles are important. Therefore, please just read the materials uploaded and listen to the lecture as well once that is uploaded. So this session is a little bit different compared to other things that we were talking about an entity. We talk about the regulation framework. That is very essential for us to understand why and how an entity carries out its operations. Without knowing what the regulation frameworks are, very difficult for us to manage our things. So it has a connection. Then we talk about intangibles. When it comes to income tax, it's mainly due to, again, part and parcel of the legal requirement. It is not something pretty much connected to operations of an entity. It is mainly because of the legislation. Government wants to take some money from businesses, or when the money is created in a society, government has to collect a revenue. As long as there is a government, government is supposed to carry out certain things in order to maintain law and order of that country, provide some facilities, maintain infrastructure, and certain areas such as education and health, where the government has a responsibility to fulfill all those things. Lots of issues are there. That's why there is a government. Then the government responsibility is to take money from the economy where the GDP is created. Then they take some money and use for the purpose. Technically, do not know practically what they really do. From that point of view, government collects tax, government revenue. So government does not earn revenue, government collects revenue from the earned income in an economy. Okay, before starting the session, like learning outcomes, can you tell me who are supposed to pay tax? Who are supposed to pay tax? Now we talk about only companies, limited liability companies here. In Sri Lanka, who are supposed to pay tax? Yes, you can type something in the chat box, or you can speak up. Who should pay tax? Or in other words, who is liable to tax? Income earners, wealth holders, okay. What else? I mean, yeah, people who earn in more than, yes, some money, okay, high income earners, persons whose income exceeds particular level of companies, okay, good. Registered entity of IRD in another department. Right. Okay. Thank you. Before starting or talking about every purchase of goods and services, yes, we have some idea when it comes to who really pays taxes and who are supposed to pay tax. Okay, I just got one last comment. All legal persons who earn income. Yes, it covers the last answer, covers a broad aspect of who is supposed to pay tax. Actually, that point is in terms of the accuracy. So that's correct. Before talking about the learning outcomes and specific things that we are going to learn in this subject, we'll clarify basic things such as this and government policies and how they are connected to the financial policies and all those things. First of all, yes, what you said is correct. Who is supposed to pay tax? Every person, right? So that is how the Inland Revenue Department or the Inland Revenue Act defines who is liable to tax. Every person is liable to tax. Every person who lives in a given jurisdiction, as far as Sri Lanka is concerned, you know our jurisdiction, it is an island. Now there is a big discussion about tax jurisdiction, pertaining to the Colombo port city. Now you can understand the meaning of jurisdiction and country. So lots of arguments were there whether the Colombo port, that reclaimed land, right? So that is an addition to Sri Lanka. Of course, it is part and parcel of Sri Lanka. There is no argument. I mean, technically, and from legal perspective, it is part of Sri Lanka. So therefore, the shape of Sri Lanka also has slightly changed. Then it is Sri Lanka. If it is Sri Lanka, it's a one country, one law. Now we are operating. So we are trying to introduce new more laws with the chairmanship of Venerable Galagodatte Nyanasara. We'll wait and see how one country, one law would be implemented in Sri Lanka, right? So you need to be in touch with these things, to be honest. So this is how learning comes. Anyway, that is something extra. You know, my examples and references always go to politics, can't help. Even taking Colombo port city, I believe not because of that I'm talking about politics and social things, not because of that my own interest, but I sense and I've realized that when you try to understand from that particular perspective, it is easy to understand, and you do not believe in things, you sense something, and that would be the better way of understanding. So case of Colombo port city is a part and parcel of Sri Lanka. But when it comes to the tax jurisdiction, of course it should be, but Colombo port city special bill excluded that, right? So now when it has its own rulings pertaining to taxation, lots of exemptions have been given. As a result, so many clauses included in the Inland Revenue Act are not going to be applicable for operations carried out in or within Colombo port city. So therefore, to some extent, with some other amendments in future, of course, that would be a separate tax jurisdiction which is free, or that is separate from tax jurisdiction of Sri Lanka. So that you have to understand. Therefore, when we define a person who is liable to pay tax, will not include a person's live in that geographical area. We'll see how it goes in the future. Okay, clarifying the thing, legal person. Actually it says every person. That is how the act defines every person. Who is an every person? Every person includes individuals, that is you and I, every individual. As long as you are an individual, so you have registered person in Sri Lanka, so legal person, individual, because two meaning, in day-to-day language, person and individual look to be the same thing, person and individual. But for tax purposes, person has a different meaning. Person is the broader word. Person means, or person includes individuals, you and I, liable to tax. Body corporate, that means any institution which has been incorporated under a particular act, that is what we call body incorporated. Therefore, any companies registered under the Companies Act are body corporate, or any other entities which have been incorporated or established with reference to certain acts, they are body corporate, like government corporations, authorities, government business enterprises which have been established by using a particular act. So they are the major things. So likewise, some other association, or likewise many. And by bringing some amendments, this person refers to some entities which are not legal even. For instance, partnerships. Partnership is not a legal entity, but for tax purposes, then they are taken in or taken as a person. But you know that later you will learn these things in advanced taxation. Uh, the partnership is used as a territory to compute taxation, whereby taxation or tax liabilities of individual partners will be ascertained. So therefore, don't worry that much about the partnerships and other institutions, charities, government entities, and all those things. Mainly pay attention on how individuals and limited liability companies come into the person, definition of person. Clear? Okay. So then you may ask a question. Even though it says that I mentioned that every person should pay tax, we are not paying tax, income tax. So other taxes we pay. Whenever you buy something nowadays, it's very difficult to exclude any person, even a beggar, whoever who buys something. Of course, lots of taxes are there, that is indirect tax. Now here we talk about income tax, that is direct tax. Then you should ask the question, no, I am not paying tax. Of course, I am paying, but you do not. Then my definition is wrong or what? I said that every person, yes, actually you are also liable to tax, but you have been excluded from income tax by offering you something called tax threshold. If your income does not reach particular level, you are excluded. It does not mean that you are not liable to tax. You are liable to tax, but you are not supposed to pay tax because your income does not reach or cross, surpass that particular limit. That is what we call threshold. Is that clear? Okay, that is things. So it should be the way. So this is the situation throughout the world. To great extent, there are some territory, even definition is like this. Every person is supposed to pay tax, income tax, but some exemptions, additional provisions, exclusions are there. I hope it's clear to everyone. If there is any question or any comment, you can ask. I prefer if you speak up rather than typing something in the chat box. Is that clear? Is that clear enough? Yeah, please. I'm afraid whether just you hear me or not. Okay. Anyway, we'll proceed. Silence implies that no questions. It really depends on you. If you ask questions, only you can dig into something. One question, sole business, oh, that is what we take sole proprietorship, right? Are we supposed to pay tax? Every person, but sole proprietorship is not a person, but if you carry out your own business, then තනි පුද්ගලයෙක් විදියට ඔයා business එකක් කරනවා නම්, ගෙදර කඩයක් කරනවා, තනි ව්‍යාපාරයක් විදියට, එතකොට තනි ව්‍යාපාරය income tax ගෙවන්නේ නැහැ. ඒක හරි. හැබැයි තනි ව්‍යාපාරයේ අයිතිකරු ඔයා. එහෙනම් අයිතිකරු තනි ව්‍යාපාරයෙන් එන ආදායම ව්‍යාපාර ආදායම කියලා income from business goes to you. You are an individual, then you are a person, you are supposed to pay tax if your taxable income comes to that particular or exceeds that threshold. So lots of exemptions are there. So that is a different story. First of all, you are supposed to pay tax. In that case, sole proprietor is supposed to pay tax, not by the business, but by the individual owner should pay income tax. Right. Income tax is one part of the government revenue. If you take the government revenue and analyze it, direct tax, including income tax, there are some other direct taxes as well. It accounts roughly 15 to 20%, more than that. 15 to 20% of the total government revenue. Rest, 80 to 85% comes from indirect. So nevertheless, now we talk about the government revenue. Government may have some other sources of revenues as well, but they are insignificant. Significant revenue, government revenue comes from tax, 98%. Now government has it this much, say roughly 1.8 billion, say 2 billion, like Sri Lanka's GDP is roughly around 16 trillion. Therefore, government revenue comes to maybe 1.5 to 2 trillion. Anyway, now you have that much government revenue, assume that 2 trillion. At the same time, government is also supposed to do certain things. The government has to spend that much money for government expenditure. Government has income and government has expenses. Revenue and expenses, government revenue and expenses. So nowadays, I really request you guys to read the recent appropriation bill, which would be explain how the intended expenses are going to be financed through different budget proposals that would be revealed on 12th of this month, coming Friday. I want everyone to listen to budget speech, read those documents, and be aware, keep in touch with what's going on about government fiscal policies. So all sort of actions, so the things pertaining to government revenue and government expenses is called fiscal policies. Fiscal policies. Okay. Remember? Okay, just type here. That is what we call fiscal policies. In case, so you know, sometimes when we talk at different forums, even so, when we use this particular word, people ask, "Oh, what's it? What's it?" Fiscal policy. We don't know. Then now you should know that fiscal policies refer to policies of the government about how the government collects its revenue and how that revenue is expensed. And if there is any deficit, that is the budget deficit, normally we can't expect a surplus in Sri Lankan context. All the time we have void gap or huge deficit, how that gap is going to be filled. So all those things are connected, mainly expenses, government revenue and expenses. The policies about these two are called fiscal policies. So fiscal policies are normally taken independently by the Ministry of Finance and other officials or the authorities. Yeah, so there are some objectives of formulating fiscal policies. Fiscal policies should be done in such a manner to establish the just and fairness, and to make sure that needy people would get benefits, and to make sure that all the functions of a government can be done. Likewise, there should be or fiscal objectives of the government, then government's responsibility is to um, determine its fiscal policies and implement them in. Yeah, so please mute your mics. Okay. Fiscal policies in that such a manner to achieve those objectives. If you're doing that way, we can call that government fiscal policies and implementation, fiscal policy implementation is good and it's effective and sound. That's really good. But unfortunately, sometimes governments, not only in Sri Lankan governments, other countries as well, sometimes disregard its objectives. They pay more attention on how best government can be run. So to find out solution that the government faces, simply disregarding the basic elements of fiscal policies. As a result, they keep on spending unnecessarily. Their collection may also be disturbed and impaired by wrong decisions, and sometimes they are politically motivated. Lots of issues may be there. Then what happens? If there is a huge gap between government revenue and expenses, then government doesn't have any other option. Government has to look at the central bank and ask them to fill that gap if the government can't borrow it. So that is what we call financial policies of a government. So financial policies cannot be independently taken if government acts irresponsibly, as what we say in Sri Lankan context. So government does not think of the importance of the independence of having good financial policies, which are normally implemented through the central bank. Again, finance ministry involves. So central bank should have some kind of freedom and independence to do so. But now that independence is compromised. So that is one of the reasons why the country is struggling. Country keeps on printing money again and again just to balance or to fulfill their expenditure needs, something like. So you better learn and understand all those things. What I try to highlight is that the background of taxation, income taxation, every person should pay tax, but there are exemptions when it comes to tax. Income tax plays that part of percentage, 20 to 15 to 20, not that big. Then again, this entire scenario of tax is called or deals with fiscal policies. There is a connection between fiscal policies and financing policies, but in a strong or managed or stabilized economy, these two policies work to great extent independently. Then economy, we can assume that economy would run smoothly. So that is something background or snapshot about the present situation in Sri Lanka pertaining to income tax. Now only we are moving towards our discussion, that is income tax. Whose income tax? We are just name here as corporate income tax. So before moving on to learning outcome, what do you mean by corporate income tax? If you pay individual, then that is individual income tax. Suppose that one of you guys, or say I am a professor of in accounting of the university. So therefore, based on my income, that is salary, I pay tax. What is that tax? Individual income tax. If a company pays tax, that is called corporate income tax. Why is that? What is the reason it to be called corporate? Yes, any idea? Because that is also another entity, only one. One company pays, but it is called corporate tax. When one individual pays, it is called individual income tax. Because you use this particular word here and there, corporate accounting, corporate tax, corporate. Why is that? Yes, I want you to speak, or just type things in the chat box, whatever. Yeah, to some extent. So it is a legal entity separated from the owners. Then can't we talk this thing as a legal entity? Why? What is the meaning of this corporate? So what you said is correct. I agree. Because one has said that it is a legal entity, of course. It has a legal identity as a legal person. That is separate from owners. Company as a legal personality, of course. Corporate means incorporated entity to some extent, but real meaning still does not come out. Corporate. What is meant by corporate? Yes. Yes, I got the answer. Collection, right? Corporate, yes, good. Collection of people. Corporate simply means together. So there are also individuals. Who are the owners? Owners are individuals. So you are individual, I'm an individual, I pay tax. But here, special form of entity, group of people get together, pool their capital into an entity. Entity carries out businesses and it generates profit. It generates an income for all the owners. Of course, the income would be shared by the owners later on in terms of dividends. So that is something else. Before dividing the dividend or the income generated by the company by the owners as dividends, but on the other hand, there's an argument that even the corporate or the company earns profit. There is no hard and fast rule that the income generated by the company should be or must be shared by owners. So there is no hard and fast rule. So therefore, there is a possibility that it may not be distributed. No matter whether the income is distributed or not distributed, owners are entitled to that income. In other words, income generated by a limited liability company is owned by number of people, group. So Inland Revenue Department takes a decision. So it is difficult for me to wait until that particular profit goes to the hands of these individuals. It may go, may not go. Even if it goes, would be difficult for me to go chase them and catch them. So therefore, it is easy for me to get hold the company. So there are 1,000 shareholders. Okay, you better settle later on. I will take the tax from the entity. Therefore, who really pays tax? Individuals. Individuals. Because the corporation, say ABC Limited, John Keel, same as commercial bank, only a name. There is no physical existence. Entity is a myth. Remember, I just I'm sure that I just talk about this. Entity is a myth. There is no entity. You can't find it. Can you find John Keel's Holdings Limited? Where? Only in the documents. You will never ever be able to touch and find John Keel's holding. That is a myth. By the same way, can you find Sri Lanka? No way. Again, you will find only people who live in a geographical area called Sri Lanka. So some tomorrow, if another country comes and just invade us, name it differently, Sri Lanka will be gone. So only myths, but those myths are some myths, but all the time, all the myths are not important for us to have a better life. But some myths help us to carry out certain things. The myth of a corporation helps in a way. There are negative consequences as well. In what ways do those myths help? To pool the capital together, it is easy and it is efficient to carry out functions. So you pool the capital, you put the capital together. Then business efficiency. So that's good. But meantime, there are lots of opportunities for individuals. Those who flock around within companies can do so many bad things as well. So money laundering, kind of corruption, lots of tax evasion, so many things are there. So nevertheless, so I'm just giving you a very big picture you can think of. So meaning of corporate is pertaining to tax. So group of people collectively pay tax. That is the meaning. Group of people called shareholders collectively pay tax, but in the name of that particular company. I hope message is clear. Now, one question. What is meant by double taxation? Double taxation is, simply speaking, if tax is imposed on certain income 2 times, it is double taxation. I know why you ask this particular question. Of course, you may have heard about this notion called double taxation involves with respect to corporate tax. Why and how? I told you, Inland Revenue Department is in a hurry to collect money collectively together. When the company earns, John Keel's Holdings earn billion. But I'm not sure whether I use the name of that company or not. Why? John Keel's Holdings has lots of tax in arrears. If you do a careful analysis of who evades tax, who escape tax, are not individuals like you and I, but big corporations, big companies. They do not pay tax. They keep everything in arrears and dispute with the Inland Revenue Department, drag it 4 years, maybe 20 years, 30 years, then influence the government to write them off. This is what the government will take. Small company, maybe in Vijayarama Junction, whatever, so small boutique or limited liability company, not assuming that company who pays tax. Company earns profit, Inland Revenue Department takes money, already that has been taken. So then there is something called profit after tax left with the company. Profit after tax. Whose money? Company earns 100,000. Inland Revenue Department took 30, 70 is there. That belongs directly to owners. That is after tax profit. Therefore, but in a limited liability company, owners do not have any other tool or any other means of getting that 70 out other than the dividends. Dividends is the mode of distribution. But what happens when dividends are paid, the government charges or imposes another tax on dividend, what we call dividend tax. Simply assume that dividend tax is 10%. So 70, 10% of 70 is another 7 is deducted. So then it is double. So earlier they charged 30, now it took 7, altogether 37. So therefore government has charged more excess tax on the same income. If that's the case, we call double taxation. Mainly double taxation involves with respect to limited liability companies. Anyway, it is generally accepted now throughout the world, you may see. Another double taxation can be seen when companies operate in two different jurisdictions. Suppose that Nestle or tobacco have come here and operate here, earn profits. They are supposed to pay tax. Nestle is supposed to pay income tax. Maybe different rates, sometimes owing just covering to BOIs for indirect investment and so many things. Lots of tax concessions may have been given. And do not know, sometimes if country pays tax in one country on its income, and if that particular, the after-tax income is remitted to another country, their parent, or the country where the parent company is located, if that particular government charges tax on that, then that is also double taxation. Normally, when we talk about foreign direct investments, international corporations, so something like that, just to promote international investments, double tax treaties are signed. That means we agree based on the jurisdiction, tax rates, and all those things. Okay, if you pay tax in this country, you are not supposed to pay tax in the other country. Or so if you have these exemptions through treaties, we call double tax treaties. It depends, but that is the meaning of this. If without having such situation, if you have to pay at 2-3 different jurisdictions, that would be all right. And I want you to read, actually I did not upload that. If possible, I will upload it. So recently held a conference of G20 summit, took a special decision about global. So that is the one, I think, yeah, I just uploaded a particular link. You better read it. I think that is the, because I was thinking of two things. Yeah, I think that's the one. Global minimum tax, corporate tax rate of 15%. This is the minimum. That means, so there are lots of cases around the world when multinational corporations involved. They go to territories where they get small tax percentages and evade taxation in other countries. That's not fair. So therefore, at least multinational companies are supposed to pay 15% tax whenever they carry out operations in terms of sales of goods or rendering services in particular jurisdiction. So that is the argument. So it's because now we have come to a juncture, and the corporation should not earn huge profits, and corporations are the people who should contribute more to the society to have such a situation where inequality can be minimized, or when the societies face lots of natural calamities, hazards, so something like, so those people can contribute. As of now, the experience is that corporations are paying very little. Yeah. So still I have not, so someone is asking about slides. So still I have not gone to the slides, okay? Just giving you the background. Okay, don't worry about slides. Okay, because slides are not for you, for me to teach. So when I come to that particular point, you can have a look. Okay, so you may be worried. Huh? Still, the first slide, I may be talking. You may think that, oh, I have just talked. No. Still, I have not gone up to that. I basically, my teaching style is to clarify the background, basic things before getting onto the slides. So then it is easy. So slides helps us to just pinpoint, okay, that and this. Okay, hope everything is clear now. These are the learning outcomes. Quickly reading, not explaining, because things will be done at the each point. Then you must be able to explain the use of information presented about current and deferred tax. Then you need to know that there are two things. One is current tax, the other one is deferred tax. What is the use of having it? Describe how income tax information is presented in financial statements. You need to know. So even though that is only one income tax, you may think that, okay, one figure. Is that the case? Or something else? Of course, something else. We'll see. So how that information is presented in financial statements. Explain the general principles of current and deferred tax. Still, I did not explain all those things. Don't worry. For the time being, remember that there are two things: current tax and deferred tax. When I talk about legal persons, I never refer to deferred tax. It is only tax, income tax, income tax. So the adjectives of current and deferred come as a result of other things, other laws prescribed in accounting standard. Yes, they are set out in LKS 12 and IAS 12 and ASB 112. Explain how and why taxable profit differs from accounting profit. We'll talk about. Then again, there are two more things: taxable profit, accounting profit. Prepare a current tax worksheet. So if you want, you can have a worksheet. Otherwise, your competency, your expectation is you must be able to prepare tax computation sheet by reconciling accounting profit to taxable profit. And then that is the tax part. After that, since we learn accounting as well, we should know how these tax involved things, expense, liabilities, assets are accounted. Normally, we need to account them in the books of accounts. Then only that information can be traced and presented in financial statements. Then the next outcome is to prepare a deferred tax worksheet. Totally different one, not the current tax sheet. That deals with tax assets and liabilities. We'll look for those things later. Then determination. You have to determine the tax basis. What is meant by tax base? It involves with deferred tax calculations and other tax, current tax calculations as well. We'll look at those things later. Calculations, another competency. Taxable and deductible temporary differences. Again, you need to pay attention. There should be something called taxable and deductible temporary differences. It specifies, it talks about deductible temporary differences and taxable temporary differences. Two types of differences. You can note them down again: taxable temporary differences and deductible temporary differences. Differences are there, but they are temporary. So there is a difference, but later on it would be cancelled off. For instance, suppose that you and your brother or sister has a difference in number of clothes. Maybe two brothers. One has 5 shirts, another one has 7. There is a difference of 2. So on one particular day, well, maybe in a particular festival or an occasion for a shopping event, they bought, you selected, you bought 7, your brother bought 5. Then there is a difference, 2. You notice it once you come home. But maybe later parents may agree, okay, no, it's not good. We'll buy another 2 shirts for Malli or brother next month when we get the next month's salary. Right? Once you get the next month's salary, the 2 shirts would be brought. Then what happens? It would be the same. So the difference is reverse. So temporary. When we talk about temporary, there should be something different. That means those differences will never ever be reconciled or compromised in taxation. There are some differences due to some reasons we will discuss. But for the time being, you have to understand the fact that the calculation involves something called temporary differences. Those temporary differences linked to deductible, some are taxable, temporary. So Inland Revenue Department tells you that we will allow you to deduct over 5 years, but you may have deducted in 1 year. So there is a temporary difference. Then you have to pay tax on certain things. But the Inland Revenue Department says, no, you have to pay tax on these things on the spot. You may try to pay tax on these things over 5 years. Then there is a difference. These are called taxable temporary differences and deductible temporary differences. There could be some differences you may incur, but the government says, no, that is not allowed, not allowable, not deductible, not a temporary difference. For example, you spent money, your company spent money for entertainment, to go to casino, you give money. So 1 million for each director to go to casino and play, entertain. Even if that's the case, they do not account this thing as entertainment. They account this thing as maybe directors, some other allowances, not as entertainment. Why? Entertainment expenses are not allowed. It has nothing to do with businesses. So practically, you may argue that, okay, when I go to casino, play casino, I may have good clientele. So this is how I should maintain my business. So prestige and all. Later on, there will be cash inflows. Likewise, you can create stories, but logically, you can't find any reasons or I mean, justify that particular expenditure for the business. That is what we call you can't deduct. It is not temporary, it's permanent. Then how those things involved. Later we will discuss. Identify items that are excluded from calculation of deferred tax liabilities and assets. So those permanent things are excluded. We will discuss about this. Describe the criteria for recognition of deferred tax liabilities and deferred tax asset. Later I will explain, not now. So what you know the meaning of differing. Differing is you take time. It happens later. Describe the other disclosures relating to income tax in the financial statements. All right. Now we'll have these things. Of course, I have slightly explained you, but have a look. Income tax are levied by the government on earned or income earned by persons, every person. I explain it in detail. Income tax is determined based on taxable profit. We'll see what is taxable profit later. But you know that it cannot be, it is not determined based on anything else. Applicable tax rates are determined through legislative processes. Here I'll just bring you to this internet. Just check 1 minute. Yeah, so you better go to this Inland Revenue Department website where you can download respective acts, Income Tax Act, Inland Revenue Act number 24 of 2017, Guide to Inland Revenue Act draft, then Inland Revenue Amendment Act, that is May 2021. Okay, so there are some other acts as well pertaining to income tax, maybe stamp duty, land tax, and all those things. Most of these tax now have been abolished. Some of the things, exemptions have been given. Mainly the government collects tax, direct tax from income tax. Okay, you better check them. So here, right. So I can show you the downloaded one. Yeah, this is the, no, this is not, this is the standard. No. Yes. I downloaded some of the things. Maybe this. Anyway, you better leisurely check them. Do you see my screen or not? I think I have stopped. Now, do you see the screen?
Yes, sir.
Okay, good. Thank you. LKS 12 explains us how we should deal with income tax when it comes to limited liability companies. So this is the standard LKS 12. So therefore, you are supposed to go through LKS 12. I will upload this as well to the LMS. You need to be aware of its objective, scope, definitions, and tax base, what is meant by tax base, recognition of current tax liabilities and current tax assets, recognition of deferred tax liabilities and deferred tax assets, taxable temporary differences. These are the things that we discussed. So details are there, we will be discussing. I'm just showing you the scope. Deductible temporary differences, unused tax losses, tax credits, reassessment of unrecognized deferred tax assets, investment in subsidiaries, branches, associates, interest in joint arrangements, then measurement, how to measure the tax, recognition of current and deferred tax, how do we account them in the books of accounts. So then we go to presentation aspect and some disclosures. So in the presentation now you can see there are three things mainly: tax assets, tax liabilities that would be deferred or deferred tax assets or deferred tax liability, and tax expense. So other than that, there would be other tax assets or tax refunds, that is also tax asset. So these are the major areas to be covered and you are supposed to know. Here you are not supposed to know particular tax rules. Don't worry about these things. In income tax, corporate income tax, we do not assess or test your competencies about whether you are conversant about the tax rules. No, that you have to learn in a separate subject called taxation or advanced taxation, that would be offered in the 4th year. Now, accounting for income tax definitions. Accounting profit is profit or loss for a period before deducting tax expense. What does it mean? It is profit before tax. What is taxable profit? Actually, accounting profit is seen in the statement of profit or loss, in the normal way that you prepare, everyone knows about. Taxable profit has to be separately calculated. You can calculate in detail by providing all the information, or you have an alternative you can take the accounting profit and make some adjustments to calculate the taxable profit. So that is the profit on which income tax is charged. Tax expense. Tax expense is the amount which is recognized in the statement of profit or loss as an expense. Once you do lots of, so you know that, say, take an example like this. During the year, assume that you have very efficient mechanism. You calculated the tax and agreed with the Department of Inland Revenue. Your tax, the amount of tax that you have to pay for this year is 50,000 rupees. 50,000 rupees. Very simple example I am giving you. Assume that you, on the spot, on the last date, you did self-assessment, got the approval, you paid it, even though changes will come later on, you paid it. Then you deduct your money, that is credit, money goes out, that is an expense. Once you deduct, asset goes down, you lose your cash in the name of tax. Who bears that loss? Owners. That directly affects to the equity. When you pay 50,000, the cash balance goes down, assets go down, decrease in assets, decrease in asset, that will give rise to decrease in equity. So that's an expense. So that is a tax expense. Got it? Therefore, tax expense always gives rise to decrease in equity. Decrease in equity. You paid 50. Assume that another 20 is yet to be payable. Then you have to add here. Your tax expense is not 50 then, 70. You credit tax payable. Now you see the difference. The tax payable account 20, cash book 50, here 70. Because by 70, your equity has gone down. In the case of 50,000, how did your equity went down? Because asset went down. That is the, just refer to the conceptual framework we discussed at the very beginning. Definition of an asset, income, asset, liabilities, income, and expenses. Meaning of expense, decrease in asset. Your cash balance went down by 50. Decrease. That gave rise to decrease in equity. Okay, expense. Second one, still you have to pay. Obligation is there, but you haven't paid it yet. How much is it? 20. So by 20,000, your liability increases, goes up. Liability increases by 20. That gives rise to again decrease your equity. When liability goes up, equity also goes up because you got to pay. So that is how it is recognized as an expense. Now you understand, right? Tax expense would be like this. So likewise, there may be some other adjustments as well. Under provisions, over provisions. The last year, assume that you underprovided something. You did not make the appropriate amount. You debited this much, credited this much, but later on, Inland Revenue Department comes and say, hey guys, last year tax computation is wrong. You have underestimated by 10,000. This year you have to pay it. Then what happens? So your payable goes up, you have to pay. Liability increases, then equity decreases. That also should be added on to your tax expense. Assume that you had an overpayment, over provision, not under provision, over provision. You paid last year 150,000. Inland Revenue Department says, so last year what happened then? When you paid 150,000, cash went down, asset decreased, equity decreased, expense. You did it. Perfect. This year, Inland Revenue Department says, hey guys, you have done a mistake. So not a mistake really. So we did the calculation. You have overpaid. Actual liability is 125,000. You have paid 150,000. Then what you can do? You can deduct that amount from the current liability. You need not to pay that much. So therefore, so the current year's liability will be reduced. If a liability reduces, that is an income. So therefore, your tax expense, since that is connected to tax, you can reduce it. If there were an overpayment, over provision, reduce the tax expense. You see, tax expense is not the actual liability. So that is the thing you have to understand. So that is the aggregate final expenditure which has given rise to net increase in asset or net decrease in liabilities, which give rise to decrease in equity. So that is the definition, meaning, and explanation. Some more items also will come. What are they? They are the adjustments arising from deferred tax. So I'm not going to explain you the adjustment because still, since you do not know anything about deferred tax, so you may get confused. Simply speaking, deferred tax, some idea is like this. There are future taxes that you have to pay, right? Because your future expenses may not be recognized as deductible expenses. So we'll come to that part later on. Just for the time being, assume that in the future, you will have to pay additional tax, which are not arising or corresponding to the statement of profit or loss. That means deferred tax liability would be there. That is also added here. You are not paying it now, you see. That liability will come later on, don't worry. But it has a connection to the equity. Equity will decrease. By the same way, deferred tax assets may also be created. How? There are certain things such as your current losses or maybe provisions for gratuities. There are so many things later we'll discuss. For the time being, assume that in the future, even though your income statement or statement of profit or loss does not have any corresponding item, but the Inland Revenue Department will allow you to deduct certain things. Deductible temporary differences. When deductible temporary differences reverse, you will get the tax benefit. In the future, you can deduct tax. Your liability can be reduced. So therefore, it is an advantage. So that by that amount, your tax expense can be reduced. So for the time, you have to understand that tax expense, current year's tax expense is not the actual tax amount that you paid, actual tax liability that you have to pay for the current year. So any adjustments arising from over provision, under provision, any adjustments arising from deferred tax assets, any adjustments arising from deferred tax liability. So there could be 5 major components in this tax expense. That's it. Equity. Don't you see the slides? Someone is this. I think so. Do you see the slides or not? Okay. So someone has asked about equity increases. No, equity. If equity increases, that is an income. Expense means equity decreases. When you pay some money, cash goes down. What happens? Asset goes down. When assets go down, equity decreases, not increases. When liability increases, the same thing happens, equity decreases. Asset decreases or liability increases because you got to pay it. That's why we deduct it as an expense. So that is the meaning of expense. You would really understand this thing if you refer back to the definition of assets, liabilities, equity, income, and expenses. So one of the things that normally we do not do when learning accounting, definition of assets, liabilities, income, and expenses, when do you learn? Maybe in the conceptual framework. You might think that, oh, okay, I have to by heart the asset, meaning of assets, liabilities, income, expenses, just to answer to conceptual framework questions. So that's the wrong way of learning. Don't do that. That definition involves everywhere. If you master the definition and interpret it properly and ask questions all the time, actually you need not to think of any journal entry. You need not to learn about any accounting treatment. You can create the accounting treatment then and there by using your brain if you are really conversant about the definition of assets, liabilities, income, expenses. So that's why I encourage you. I know that it is hard, but if you learn in that way, you need not to by heart any accounting entry. I never ever keep in mind, so where debit and credit goes, double entries. It is really useless exercise. Don't do that. Think about the logic. Take the logic, then it should be debited, credited, just argue. In that way, it can't go wrong because the conceptual framework has given you the base. Constitution is there, then it can't go wrong. Now you understand. So current tax amount, therefore, tax is the amount of income tax payable or recoverable. So tax expense is different from current tax. Current tax is the amount that is yet to be payable. In my example earlier, I paid 50,000 and there was another 20,000. So what is the total payable amount? 70,000. Therefore, the current tax is 70,000, of which 50,000 has been already paid. Therefore, what is payable is 12. So current tax is the tax applicable for the current period, or the tax recoverable during the current period. Suppose that you did not have an income, you had a tax loss. In Sri Lanka, basically, they are not refunded, they are recoverable maybe in the future. Yes, but in some other jurisdiction, automatically that amount would be refunded. So therefore, it is an income tax, current tax. Right. Now, some definitions. Before talking about the definitions, just we'll have a 5 minutes break. I need to take a drink. Remind me. All right, thank you. So now deferred tax liabilities. Deferred means you take time. Kal ganima karane, differing. It's not difference. Defer. ඉස්සරහා කාලයකට මාරු වෙනවා. ඒක තමයි deferred කියලා කියන්නේ. එතකොට දැන් මේ deferred liability එකක් කියලා කියන්නේ liability will arise in the future. That is the meaning. For example, like if you earn 5 million, if the tax rate is 10%, then the 500,000 will be the tax liability. ඒ කියන්නේ current අවුරුද්දේ 5 million, 10%, 500,000 is the current tax liability. You got to pay it now. Maybe now or within a year. So normally time period is given. ඒකට කල් ගන්න බෑ. කල් ගන්න කියන එක, so defer කියන එක තේරුම් ගන්නට ඕනේ. Even the current year's liability, for example, say something like taxable profit 100,000 rupees. Easy. Tax rate is say 24%. Then tax liability is this into 24%, isn't it? 24,000. So when are you supposed to pay? You are given a time limit within 3 months. So I can't remember exactly what the time period is. So you have a time period within which you have to pay unless you what do you call contradict, dispute it, or otherwise willingly you may not be paying like many corporations do, doing say that and this, saying that and this. So tax arrears is not differing something. ඒක අපිට නිකන් කල් දීලා මේක අපේ වැරද්දක් නිසා තමයි අපි ගෙවන්නේ නැත්තේ. Your liability is 24,000, you are supposed to pay it. If you are not paying it, that is your problem. You are accountable. So deferred tax liability කියලා කියන්නේ something else. ඒ කියන්නේ liability එක ඇති වෙන්නෙම ඉස්සරහදී. Not now. You carry out certain businesses this year. In arriving to this particular accounting profit, say you depreciated some items at a particular rate. So depreciation is not an expense. Therefore, but you depreciate, say in 5 years. So 5,000 something like. Value of the asset is say 20,000. This is how. Inland Revenue Department says, okay, just to promote you. So this is how this is depreciation. Inland Revenue Department says, no, don't think too much about deferred taxation, just to explain you this deferred tax liability. Meaning of differing. ඒ කල් ගන්නවා කියන එකයි අර අපි tax ගෙවන්න නැතුව හැංගිලා ඉන්නවා හොර වැඩ කරනවා කියන එකයි දෙකක් ඈ. Just for the simplicity, capital allowance or Inland Revenue Department says, okay, entire 20,000 can be deducted now. What happens in arriving to this particular taxable profit, right? Inland Revenue Department has allowed you to deduct 20,000 as allowance, deductible allowance. So therefore, what would have been the accounting profit then? Accounting profit could have been then this plus this 120,000. But in addition, when it comes to the accounting profit, certainly this depreciation charge must have been deducted. Must have been deducted. So therefore, our accounting profit would not have been 120, but should be like this, 115. So this is the accounting profit. Okay, very simple example I have taken. Assume that accounting profit before interest, before taxation, after charging everything, right? 115,000. So Internal Revenue Department does a detailed calculation to determine the taxable profit. But in a simple way, if you try to adjust it, how do we take this taxable profit is you need to add back depreciation, because depreciation is not allowed. That is not an expense, cash expense. Therefore, that is added back, this 5,000. It would be then 120. Then less capital allowance. 20. This is how taxable profit comes. Did you get the point? This is how your taxable profit comes. Then what happens? You pay tax on this. If the rate is rate is 24%, your tax liability would be 24,000, like here. 24,000. Then what will happen in the next year? Assume that this is 2021. This is 2021. So this rate not seen properly. 2021, this. 2022, assume that we had the same accounting profit. For the simplicity, right? You had the similar expenses. Therefore, with the depreciation, sorry, accounting profit after deducting depreciation, this is the accounting profit, similar accounting profit, 115. You got it? Assume that you did not acquire any assets. No, there's the same scenario. You charge depreciation. In 2020 also you charge depreciation. After that you have this much. Then when it goes to taxable income, this is for 2021. This is for 2022. Accounting profit is also the same. I'll take it here. Already you have charged depreciation. Therefore, depreciation is also there. Then it becomes 120. What is the capital allowance? 0. No capital allowance. So therefore, taxable profit would be 120,000. You see now, next year, even though you account for 115 as accounting profit, you will have to pay additional, if you take these two difference, additional tax. Tax on this 15,000. So that is what we call, why does it happen in the future? Because of the tax arrangement did in 2021. The 2021 is the year in which you claim for this capital allowance. That would reverse in future. Whenever you charge, it would reverse. Therefore, additional liability will arise. So this is what we call, so later we will be discussing deferred tax liabilities, right? Deferred tax. So you have option now. One is, you have two options. Okay, don't worry. If that is the situation, we will pay more tax in 2022. That is one option. We'll pay the current year tax. If that's the case, how much do we have to pay? So same profit, accounting profit is 15. Likewise, then taxable profit is this much. Therefore, taxation would be 24% into this much, 24,000. So likewise, then what happens if you do not think of deferred tax liability and all those things? So this is the way you calculate. In undo department say, hey guys, pay 24,000 this year, 28,800 next year. Is that all right? Yes, of course, it's all right. But we have a constraint due to some, like mainly the accounting standard says, no, don't do this thing. Because if you allow like this, it looks ugly and violates the matching principle even, because the same accounting profit reported here, same accounting profit, same tax rate, that is 24%, but you are paying two different taxes. That's not nice. So therefore, you better make the adjustments that you will have to pay in future because of these taxable temporary differences. So the entire work of deferred tax liabilities, this additional tax that is going to be paid in the future would be accounted here and take it here in complying with the accounting standard. So that is the requirement. So therefore, we comply with accounting standard and matching concept. So someone has asked how to get accounting profit. Accounting profit, here I did this like, how to say, indirect reconciliation on the assumption that taxable profit was this much, there was an allowance of this much, and depreciation of this much. And likewise, if you normally take accounting profit, it would be like this. It would be like this. Revenue. You ask about accounting profit. Okay. Accounting profit is the profit before tax. Cost of sales, say 300,000. GP then is minus all expenses, operating expenses, say 85,000, interest 15,000. So therefore, profit before tax is minus this, minus this. This is what we call accounting profit. If I just go to the same example, the same scenario, this is for 2021. Assume that you had these operating expenses included 5,000 depreciation. Therefore, starting from this accounting profit or profit before tax, you need to do adjustments. You need to add back depreciation. That is 5,000. You add back. Therefore, sorry, accounting profit I wanted to make is 115,000. I'm sorry, then I'll change it to be it should be like this. If you want to have the same example, 115,000 is the accounting profit. So we know that there was a depreciation of 5,000. You add it back, this plus this. But since the capital allowance of 20,000 is there, that is minus 20,000. So automatically now you get this plus this. So this is what we call taxable. Later we will do the calculation just to get very simple understanding. This is how it varies. Is that clear? I hope it's clear. If not, please ask. So this is what we refer as deferred tax liabilities. Okay, good. Capital allowances, I'll come to that one under the deferred taxation. Suppose that everyone knows about depreciation. Depreciation is not allowed for tax pay the purposes. That means when the Inland Revenue Department calculates income tax liability for companies, they say no. Depreciation you have charged on your formula, accounting standard. Actually, depreciation means there is no actual expense. There is no cash outflow. That is a notional charge. So Inland Revenue Department says no. However, you know that when we Inland Revenue Department or the fiscal policies have objectives of economic development of a country, then there is an argument that when corporations or the limited liability companies buy machines, why do they buy machines? And normally in accounting, what we call property, plant and equipment, to carry out its business operation. If the government wants to promote business operations, they give some supports, some concessions. Therefore, throughout the world, to great extent, when a company buys fixed assets, machines, there are certain categories, the amount in my example, the value of the asset is 20,000. That is why the company depreciated it in 4 years, 555. So Inland Revenue Department may have its provision. Okay, if you buy new machines, assets, full amount can be deducted when you arrive to your taxable profit. Just to encourage you. Or the full amount, normally full amount can be deducted in 1 year, in the year in which you buy, or in 2 years, 50%. You know, some countries give you 200%. If you buy a machine for 20,000, okay, you can deduct 40,000 from your. So what does it mean? Inland Revenue Department or the tax policies encourage businesses to engage in more and more in the production. That is the idea. Economic development. So this deduction is normally called in tax capital allowances. Capital, good that you asked. Why it is meant by capital? The capital there, they assume that when you buy machine, so that is something that you fix in the business. That word has come from somewhere. Capital to run the business. Therefore, we'll give the amount or the capital that you spend to buy machines as an allowance, maybe in lump sum in the year in which you acquire, 2 times, 3 times, or maybe 200%. It's that is where you need to check the Inland Revenue Act. Here in Sri Lanka, there are so many different rates applicable. For some items, 100%. For some items, even more than 100. Even 100%, so that is allowed in 2 year, 3 year, something like that. Don't worry about these things. So those things will be learned. Why depreciation is added? Because for the tax purposes, depreciation is not an expense. That is the meaning. Depreciation is an expense because of the accounting standard, property, plant, and equipment. For the tax department, they come and they look at, have you paid any money as depreciation? No. Therefore, no, that is not an expenditure. This is what we call, so some differences. But nevertheless, we'll allow you to deduct certain amount based on the machine that you bought. So therefore, depreciation policy is ours, not the that of Inland Revenue. Inland Revenue Department recognizes the cost of that asset utilized in buying the machine or whatever at a different rate. So these are called temporary differences, taxable temporary differences. That is taxable. Not taxable, deductible temporary differences. So you can deduct, but in a different way, not in the way that you like. It has to be deducted in the way the Inland Revenue Department asks you to do. What is the way I took here? Inland Revenue Department asks you to deduct it once in the year in which you bought it. Perfect. But you deduct it for 4 years as depreciation in arriving to your accounting profit. So that is why Inland Revenue Department does not regard your exercise. They say, okay, no worries. Whatever you do, forget about. You deduct as I tell you, it is 20,000. You deduct. But next year, what will happen? Still you keep on because your mechanism is deducting depreciation. But Inland Revenue Department says, no, sorry guys, we can't give you allowances every year. We give the allowance only in the year in which you bought it. It's gone, already given. So therefore, if you have deducted 5,000 more, please add it back. So that is the reason why in 2022, we will add it back. Therefore, so additional tax liability will be created. So this additional tax liability would be dealt with deferred taxation. We will discuss this thing tomorrow. So likewise, some items will give rise to deductible, on the one hand, deductible tax liabilities, and sometimes it would be deferred tax assets. So deductible liabilities arise as a result of taxable temporary differences. Deductible or the deferred tax asset will arise from deductible temporary differences. So here, taxable temporary differences. What is taxable? The depreciation, the allowance. So that is now so later we will discuss. For the time being, remember that there is something called taxable temporary differences and deductible temporary differences. Now you may not understand unless I take an example. So it's too early to go to that example now. So apart from that, there will be some carried forward tax losses and tax credits. I will explain what they are tomorrow. General principles for income taxes is tax effect method should be used. What is the tax effect method? If you do not follow the tax effect method, tax liability method, you have to pay only 24,000. Tax effect method is you take into account the future taxes that you are supposed to pay, right? And you make the provision. In this particular case, you need to add another additional amount of 4,800. So later we will see how the calculation would be done. So therefore, tax effect method takes into account all the tax effects, no matter whether that particular tax will be paid in this year or future years, or tax benefits would be taken in this year or future years. We take them into account the current year. That is what we call tax effect method. IRD means, someone has asked, Inland Revenue Department. Inland Revenue Department. IRD means දේශීය ආදායම් දෙපාර්තමේන්තුව. ඒගොල්ලන්ට තමයි බලය තියෙන්නේ මේ වැඩේ කරන්න. Okay. So this tax effect method is discussed and explained in LKS 12 and ask you to recognize the overall tax liability. Remember, I told you not the liability, over provision, under provision, deferred tax, asset, liabilities, everything will be taken together and adjust what is the ultimate liability that you have to show. Current tax liability is calculated based on current year tax profitable. So taxable profit. So in my example, what is the current tax liability? In this example, current tax liability is this much, 24,000. That is for the current year. But the tax effect is different. So first you have to recognize current tax liability. That is the amount that comes as a result of the application of the tax rate into the taxable profit. Deferred tax assets and liabilities are estimated based on the financial position statement. So that is calculated later, we will discuss based on the tax basis. We take into account what would be the future tax to be paid in 2 year, 3 year, 5 year. Okay, take. What would be the future tax claims in 2 year, 3 year, 4 year, 5 year? Take everything together, account either as assets and liabilities. You know that whenever you generate an asset, it is increase equity income. If you increase a liability, it reduces equity. That is an expense. So this is how you have to pass the journal entries and account for it. Income tax expense for the period already I explained you. Current tax liability, deferred tax, and current tax liability include the rate plus the over provision and under provision. The same thing is there. So therefore, the balance sheet should disclose not only the current tax liability, but also deferred tax balances as well. We'll have a quick look. This has been taken from your chapter, that is there in your chapter. Have a look. Libran Limited, 2017 and 16. Under non-current assets, deferred tax assets are there, 51,000 and 45,000. So relatively significant amount. That means in future, the Libran company will get tax benefits from the Inland Revenue Department of that country. Current liability is the current tax liabilities. That is the amount. In my example, it is 24,000. This 78,000 is equivalent to 24,000. Amount arising from the current. Non-current liability is 120,000. So that is the difference. Just remember, 28 next year it would be 28.8. Then 4,800 would be deferred tax liability, something like that. So likewise, some other implications are also there where you have to pay more taxes. The classifications are shown. Sometimes some adjustments will be there in other statements as well. I will take, this is from your textbook, but I will take some direct references from Sri Lankan annual reports and show you tomorrow how these are disclosed. And then, yes, current tax liability, quickly, I'll take 5 minutes and finish it. Already explained. How is it calculated? You based on the tax rules, you rearrange your tax computation or the taxable profit. Once you reach the taxable profit, we can exclude all those things for the time being. And have a look here. This is how it is calculated. You do all these adjustments and finally apply the rate, and that is the current tax liability. In Sri Lanka now it is 24, but pertaining to some businesses, different rates would be there. It's a matter of application of the rates. Don't worry about the rate. For you guys, rate would be given because this is not a tax class. So we are learning accounting for income tax. Then you start from the accounting profit. In my example, 115,000. You deduct any special allowances given, like depreciation allowances, the government grants or whatever you deduct. You will add back which are not allowed for tax purposes, whatever, such as depreciation, impairment, any other provisions likewise. So we will discuss with an example. What you have to remember that the reconciliation between accounting profit and taxable profit depends on the provisions given in the Inland Revenue Department and the LKS 12. They are the tax rules simply. So tomorrow, please compute already. I think answer is there, but still I have not uploaded this one. I will upload this tonight. I just wanted to add some more. So can you quickly write down this? If it's not going to be uploaded, so work out based on the knowledge. Give a try. Quickly write it down and calculate the current tax liability. With that, we will wind up for today. I hope still you can see the screen. Right. So while you are writing down, you can ask questions if you have. Let me know once you have finished it. With that, we can stop the recording for today. So if you just summarize what I just explained, actually I just gave you very broad explanation about the background of income taxation, why it has become corporate taxation, the background, the rationale of taxation, its implication, and the difference between mainly the accounting profit and taxable profit, and how we would get along with computation. That will be discussed tomorrow at 1 p.m. With that, I can conclude the recording. Then I stop.